All right. Let's have some fun here. So this is the first ever Pinto State of the Game on X. And we are at 61, almost 62 cents. And my intention is to use most of this time to talk more about low volatility money and why being at 62 cents, from my perspective, is not only part of the process, but is generally a very encouraging data point. And I think this is a topic that has been quite controversial within the Pinto community. And given that it's controversial within the Pinto community, can only imagine how potentially controversial it is, or how much disagreement there may be in the larger crypto community about this, given all of the trauma around algo stables. So from where I sit, one of the defining changes that were made from Pinto to Beanstalk is rebranding things away from algorithmic stablecoins and moving the discourse to low volatility money. And this was a response to the overwhelming negative sentiment within the Beanstalk community every time the system would depeg. And from where I sit, depegs, or in the case of Pinto, where we've moved away from a peg even because that sort of implies too much hardness to the stability, we're now using the term value target. When the Pinto price moves away significantly from the value target, there is effectively an explicit trade-off space that Beanstalk was and Pinto is operating within, where the trade-off is effectively how much time is the protocol willing to spend away from its value target, and how much is it willing to pay in order to minimize the time away from its value target. Future versions of the system may also care about magnitude away from the value target, but at the moment, the protocol really is making a trade-off that it would prefer volatility at some level. It would prefer to have price deviations away from the value target in favor of long-term stability. And given that this is a trade-off space that these types of algorithmic forms of money have to follow, and given that it seems like, I think quite definitively, based on the data that we've gotten from previous attempts at algo stables that have tried to maintain a hard peg, like Terra Luna, that doing so is simply impossible. And therefore, by definition, the optimal trade-off here is to trade some amount of volatility for long-term sustainability. And then the question becomes, well, how much volatility needs to be traded in order to create the stability in order to create the sustainability. And that's where things, I think, get really interesting. So the history of these algo stables has to really start with the basis model. And the basis model was very interesting and had a tremendous amount of support. I think it raised something like $100 million privately before even launching, and it never launched. Where the idea for protocol price maintenance was that there would be some epic, and basically the protocol would measure how much demand it needed to generate in order to return the price of the basis stablecoin to its value target immediately. And then it would run an auction to sell enough debt in order to generate enough demand to return the basis price to its target in that auction immediately at any price. And this is a pretty scary way for the model to act from my perspective, because The issue is with a debt-based protocol, it's like in the short term, you can minimize volatility, but if the interest rate that has to be paid in order to create that demand is tremendous, that at the margin, that actually really hurts the health of the protocol. Let's say that the protocol pays 1,000,000% on $100,000 of demand. That's going to create a tremendous amount of debt that the protocol will eventually have to pay back in the future. And depending on the payment schedule on the debt, that is highly likely to diminish the attractiveness for the next marginal lender. And so, what this sort of going through this basis example exemplifies is you can have a design where the protocol says volatility of any type or any magnitude or any time needs to be minimized to the maximum extent possible. But in exchange for doing that, where the protocol is saying at any price, it will sell the debt in order to return to its value target, it is highly likely that that makes it really hard for the next time there's a depeg or a decrease in price from the value target. The next time that happens, the protocol is going to have to likely pay even more interest because the debt profile or the health of the system has changed quite significantly. And this is something that has a reflexivity to it, where the more debt that the protocol issues, the higher the interest rate the protocol is going to have to pay. And this has the potential to run away from the protocol in the sense that it may issue so much debt that it finds itself unable to attract the next marginal lender. And in doing so, ultimately kill itself or significantly hamper its chances of long-term success and sustainability. So basis is at one end of the spectrum. And maybe the opposite end of the spectrum is Bitcoin, which is not by any stretch traditionally considered an algo stable coin. But if you're willing to keep things somewhat abstract, it may be helpful to think of Bitcoin as a currency that has no stability mechanism whatsoever. So the algo is maximum trustlessness and basically has no interest in minimizing volatility whatsoever. But as a result of not caring about minimizing volatility whatsoever, it is maximizing sustainability and maximizing the ability for the protocol to simply keep living and keep functioning. And Bitcoin has obviously found tremendous product market fit as a store of value. And so where I think things get interesting is once you start to accept this trade-off space, once your goal is to no longer create something with perfect stability because there's a recognition that sustainability is not possible if perfect stability is the goal. And you could say, well, STC, USDT, we would say those are not money. That's not money. That's a collateralized wrapper on some other money. So if the goal is to create perfect stability, you're not really going to be able to create money. Instead, you can definitely create a very sustainable money that has no notion of minimizing volatility, and that has the potential to be a good store of value. I'd say good luck competing with Bitcoin at this point. But where there does seem to be real room for innovation is answering the question, is there a sufficiently low amount of volatility that can be achieved in a sustainable fashion such that there is the potential to create utility for a currency, a cryptocurrency, to serve as a medium of exchange and a unit of account. And this is the problem space that Pinto is designed to work within. Pinto is not designed to create a system or to create a currency with no volatility. Pinto is designed to, in a sustainable fashion, while having a comparable level of sustainability to Bitcoin, to minimize the volatility of the Pinto currency price as much as possible, in the hopes that through dampening the volatility of the Pinto price enough, that Pinto is able to find product market fit as a medium of exchange and a unit of account. And you may say, well, why would people prefer to hold something with some volatility? Like if I as a holder am going to accept volatility, why not just hold Bitcoin, which is the most trustless and most sustainable model possible? Why would I use anything else? The answer is it's too volatile. So the fact that the currency does nothing, the Bitcoin protocol does nothing to dampen volatility, has resulted in a significant amount of volatility that makes it hard to use for things like currency is often used, which exchanging value, unit of account for borrows and lends. Bitcoin has not been able to find product market fit there from our perspective because of its volatility. So there does seem to be a demand for a low volatile asset. And then on the other end of the spectrum, you would say, well, why, if you want low volatility, why not use USDC or USDT? Why would you use something like Pinto? There's two things. One, there's a trustlessness element where obviously USDC and USDT are significantly more trusted than a system like Pinto. And there are centralized entities that can arbitrarily censor holders of USDC and USDT. But more than that, from an economics perspective, Pinto holders earn yield for holding Pinto. And so Pinto doesn't just say, trying to create a currency with lower volatility than Bitcoin. It is trying to create a currency with low volatility compared to Bitcoin and some form of native yield from the seigniorage of the currency that is in some way used to minimize volatility. So it's not just that there's lower volatility and yield while preserving a certain amount of trustlessness, as high a level of trustlessness as possible, which is, from our perspective, orders of magnitude better than the level of trustlessness of USDC, USDT. And obviously with USDC, USDT, you have almost no volatility, but you also have no yield native to the holding of the currency. Now you can use USDC and USDT to collect yield elsewhere in DeFi, but that's fundamentally different than just for holding the currency earning some yield. So Pinto's niche, if you will, is sufficiently low volatility to be a medium of exchange and unit of account, sufficiently trustless to complement Bitcoin as a base currency of a trustless economy, but also sufficient yield to compensate holders for the excess volatility experienced in Pinto over something like USDC and USDT. And once you're in this headspace of perfect stability is not possible in a sustainable fashion, and instead the problem space is simply, can we design a system that minimizes volatility sufficiently to create utility or the potential for utility? Now the question becomes totally different, which is how much volatility is acceptable? How much volatility is too much volatility? And this remains an open question. But within this frame of reference, already the protocol is no longer failing. And I think this is some of the negative sentiment comes from a misunderstanding as to what the protocol is actually trying to do. Like Pinto is not trying to stay at its value target in perpetuity. That is not a sustainable model. Pinto is trying to figure out how can it minimize its volatility as much as possible while maintaining stability. And so at 61 cents, if you're expecting perfect stability, it seems like the thing doesn't work. But if instead you're trying to understand, well, what is the least amount of volatility the system can create in a sustainable fashion, now there's some follow-up questions that need to be asked around 61 cents. I would say the first is, how quickly, over what period of time, has the price come down to 61 cents? And the second question that I think has to be asked, which is deeply related, is during this deviation from the value target, what has happened to the value that trades against Pinto? So Pinto, very interestingly, inherits the volatility of the assets that it trades against. So in some sense, the portfolio of assets that are being used to provide liquidity against Pinto, without any sort of endogenous incentive structures in the silo and field, Pinto would just track, assuming there was no trading activity whatsoever. The price of Pinto would basically track the index of value that trades against Pinto. And if you look at the price action in crypto over the past couple of weeks or the past month or so since the deviation started, you can see that a large part of the deviation from the peg, and it has been just about a month. It'll be a month in 2 days. What you can immediately see is that a large part of the deviation in the price has come from just a large downward price movement in the crypto market as a whole. And so Pinto, over the past month or so, as it's had a deviation from its value target, has largely tracked the downward price movement of the crypto market. And you could say, well, isn't it supposed to do better than the general crypto market? And to that, I would say definitely. Like, the goal is for the endogenous incentive structures within the system to make it such that despite the fact that the price of Pinto at base level tracks the general market as an index, or the liquidity that trades against it as an index, that it should be able to do better than that in terms of volatility, but not necessarily always, because obviously the protocol has to deal with inflows and outflows as well. That is sort of an additional layer of volatility that gets not averaged out, is probably not the best way to say it, but get mixed in with the price action that's a result of the liquidity that trades against it. And I think from this perspective, it's quite reasonable to say, well, I wish the protocol were performing better. That I wish that as the price of the crypto market has come down, that Pinto would have held up slightly stronger, that there would have been more convert activity or demand for sowing in the field, such that the price wouldn't have dipped so hard in line with the rest of the crypto space. And this, I think, is perfectly reasonable. I too wish that the Pinto price held up a little bit better over the past couple of weeks as the crypto market has come down. But already within this frame of reference, the discussion is quite different from a binary of, is the system at its value target or not, therefore it's working or not, to, at the margin, how is the system performing compared to how it could otherwise be performing given the inflows and outflows and given the general trends in the crypto markets. And I think within this frame of reference, it's a much healthier discussion to have around what's actually happening in the protocol. Like, within this frame of reference, the questions now become, well, what was the demand in the field? How active is the field right now? Is the protocol able to attract lenders? What is its ability to change its deviation from its value target based on the efficacy of the field? And similarly, with respect to the silo, what has been the demand for converting within the silo? And what is the effect of conversions on peg maintenance or protocol maintenance? And I think within this, we're already now getting into the discussion of the inner workings of the mechanism. And so, before speaking about any of that, and unclear if that's the best use of our time here, but I want to digress and talk about how, in the grand scheme of things, you could say that this level of volatility, where the Pinto price volatility is similar or comparable to the general market volatility, is a data point that the system doesn't work. And on this front, I could not disagree more. Where, from where I sit, you have to look at the history of algo stables, and they basically all with the sole exception of Beanstalk, which was the first step in this direction. They all do well for a period of time and then collapse. And collapse once, maybe twice, after the first collapse. Sometimes they get bailed out. But effectively, there's a super quick collapse. There's a run on the bank. And as a result of the run on the bank and the lack of the protocol's ability to resist or be anti-reflexive during a run on the bank, the protocol basically blows itself up. And we never saw this happen with Basis because it was never allowed to launch. But we did see this with ESD, DSD, RSD, TSD, all the like. We saw this with Terra Luna. And the list goes on, where everything's hunky-dory, everyone's participating in the system. And then as soon as the yield dries up, as soon as there's a deviation from the value target downward, the protocol basically blows itself up. And so this was the status quo for these types of protocols prior to Beanstalk. And with this historical frame of reference, I think it adds a lot more credence to the idea that hanging out in the 60s is actually a huge success, is a data point that creating low volatility money is actually possible. And particularly in the context of, if you think about the volatility that has been experienced by the major cryptocurrencies, particularly in their early days, Bitcoin has experienced many 80+% drawdowns. Ethereum has experienced many 80+% drawdowns. The list goes on of cryptocurrencies that throughout their adoption over many years have gone through tremendous, large, dramatic price deviations or price movements. I think it's much more reasonable to think about Pinto in reference to those currencies and to compare the volatility that Pinto is experiencing to the volatility experienced by those cryptocurrencies. And I think from this historical perspective as well, the protocol is doing really well. And I say all of this because I feel like as much as we try to make this point clear sort of at face value with the movement to terminology like low volatility money and value target instead of algorithmic stablecoin and value peg, that there still is dissonance around this point. And it's dissonance that should be, from where I sit, directly addressed and addressed thoroughly, because people need to let go of the idea of algorithmic stablecoins. I think in a perfect form, let's say Pinto works and it works for decades, and it ends up being that hundreds of the smartest people in the world are all working together to figure out how they can iterate on Pinto and make it as efficient as possible. Still, I would say it's not an algorithmic stablecoin. It's algorithmic low volatility money. Stable is too strong of a property. And unless you're going to give up on trustlessness and scalability, I guess I should say trustlessness or scalability, because you could have something like LUSD that's hyper efficient. It's going to be impossible to create stability. So maybe the right way to think about this volatility and the volatility that Pinto is experiencing is the magnitude of the volatility and the time over which the magnitude is experienced. And in some sense, you can think of the model, particularly an advanced, future, more sophisticated version of the model, you can think of it as being something that should be minimizing both the length of the deviations and the magnitude of the price deviations. And then it's like, all right, well, how long between oscillations above and below the value target, and how big are these oscillations? And this already now becomes a much more reasonable problem to solve. And then it's like, all right, well, what can we do in each of these circumstances? And in order to get into this, we'd have to get into the ins and outs of the protocol and all the incentive mechanisms. So this is the most important thing on my mind today, having been engaging with some of the members of the Pinto community over the past couple weeks. And I feel like until we are all on the same page about what it means to be low volatility money and what it means to really let go of the idea of an algorithmic stablecoin, it's going to be hard for us to properly communicate to the world just how exciting all of this is. If people view being at 61 cents as a failure, it's going to be very hard to convince people that this thing is going to change the world. And from where I sit, 61 cents is very far from a failure. In fact, 61 cents is a tremendous proof of concept that you don't need perfect stability and that there's a sufficient incentive structure in place already that people feel compelled to stick around, even as the price shows no short-term hope of improving significantly. And accordingly, or as a result, there also doesn't seem to be any yield expected in the short term. The fact that there is millions of dollars of value that continues to be held in the protocol, despite those facts, to me is a very strong indication that the incentive structures in place, in particular the stock system, continues to work well and can be the foundation of a system where bank runs are minimized and discouraged and sustainability is achievable. So that's my opening rant. I think maybe, and I know this is our first time on X, so might be a little rocky, but want to invite anyone to come up and respond or ask questions to what was just said. And then depending on how long we have questions, we'll take it from there.
You should be a button to speak if people are interested. Ford Pinto, you are now.
Hello, hello. Can you hear me?
Yes.
Hello, hello. Yes, you can hear me. So first off, you mentioned no hope of prints in the future. I would say that's wrong. I mean, sentiment changes on a dime. As soon as somebody comes in and starts sowing, people will hop on the convert train, and this can turn around pretty fast. And especially with the fact that now there's less incentive to convert down immediately across peg too, then you get rid of the people that are just overly anxious about converting into LP. And so I'm pretty optimistic. I don't know when it will happen, but at some point the system is going to turn around sooner or later. And normally when it does, it tends to do that pretty quickly. So, I would not be so pessimistic personally, but to each their own.
Well, I didn't mean to communicate pessimism necessarily. In fact, I meant to communicate optimism from the perspective of just acknowledging that, like, in the next 24 hours, I don't expect there to be any mints. And I don't think it's particularly reasonable that, based on what's happened over the past month, that anyone thinks it's highly likely that within the next 24 hours, they're going to start receiving mints from the protocol. That despite that fact, there seems to be basically no one leaving the system, that most of the outflows have effectively dried up. That to me, this is very bullish, right? Like if you look at the history of algo stables, it's basically a mercenary liquidity situation where people come exclusively for the yield. And as soon as the yield dries up, everyone leaves, right? So right now, I think we have a very different dynamic at play, which is super powerful and bullish. It's not pessimistic, but in order to realize how bullish it is, there has to be a recognition that at least right now, there is no yield expected in the next 24 hours. So it's like, well, people are then by definition realizing an opportunity cost to not withdraw their value and then put it back in later, right? They could withdraw their value, earn some other yield, call it 5-10% at least from another protocol, and then come back when the mints start again. The fact that not everyone has left is a huge bull signal from my perspective, but it is rooted in what you could say is pessimism. I just call it realism, which is that at 60 cents, it doesn't feel realistic that in the next 24 hours or so, there's going to be any mints. That could, of course, change at any moment. And in order to get into like, well, what would it take for the tides to turn? That's, I think, a whole separate conversation. But for me, I was not trying to communicate pessimism, and appreciate you, Ford Pinto, for calling that out and highlighting that. don't want to miscommunicate on that front. But for me, it's just about being realistic that right now there's no yield expected and still people are hanging around.
Cool. I see. Yeah, thanks for clarifying. 24 hours is an extremely short time frame. I'm thinking more over like the next few weeks, for example.
Yeah, I mean, it's all a matter of perspective. But when it comes to financial decision making, particularly in an ecosystem as frictionless as on-chain finance, right, it's pretty low friction to just take your value, move it somewhere else. This is the whole yield farming meta. So in some sense, it's like the system needs a way to transcend the yield farming meta, and it seems to be doing a decent job of that. You know, this to me was actually like a big part of the meme around the farm, right? And branding everything as being a part of the farm. It is sort of a direct response to like the yield farming stuff. Like this is actually a farm where people stick around, where people have a community, where people are cultivating something meaningful and long-term. They're not just hopping farm to farm. This is the farm. So a little bit of an aside, but I feel like it's directly related to this idea. Curious if others have anything they wanted to say or respond to the opening rant.
Hey guys, can you hear me?
Yes.
So Ben, you spoke a little bit about, or maybe a lot about stability or like volatility. What do you think about doing something like that when it comes to the yield itself as well? In case of like, reducing the volatility of the yield and maybe stabilizing a little bit. So it's similar to, I guess, the kind of we're saying like a constant, percentage of yield that comes in there. Do you think some form of like a stabilized yield is helpful for participants or for those who are in there? Or I understand that messes up a little bit with big maintenance, but maybe like a 1% or 2% shouldn't affect it or impact it much, or is acceptable, I guess, when it comes to the volatility of it.
Well, I think fixed yield is great. If you go back to this trade-off space we were talking about before, where Pinto is basically compensating holders with some yield in the form of seniorage to compensate for the lack of stability that a holder of USDC or USDT would get. Obviously, that value proposition is downstream of what is the yield and what is the consistency of the yield. And so some notion of making the yield consistent obviously improves the utility of the currency. Now, there's a couple open questions there. It's like, well, does the stability of the yield compromise the sustainability of the yield? Does the stability of the yield compromise the amount of yield? Like, would you be able to earn more yield if it was volatile versus less yield if it was stable? And then there's a question of, well, can the protocol afford to pay the yield? And in my mind, I try to bifurcate. There's basically two ways to create stable yield. One is for, at the base level, for the protocol to say at all periods of time, there's simply going to be some amount of seniorage that is guaranteed for holders. And that could be 1 or 2%, like you suggested, Mod. That could be 20%, like what was promised with Anchor. And it's likely that at some base level yield, there would be a lot of participants looking to collect that yield that are willing to hold the currency. And I think in some sense, you could make a very strong argument like, great, definitely do that, pay out that yield, attract sustainable holders. And that seems to be a great growth strategy. It's like a growth hack. However, I think what we learned quite definitively from Terra Luna was that if the protocol pays out some fixed yield and does so in perpetuity, but does it in a way where there's no actual source of value creation to pay for that yield or to pay that yield, that at some point the chickens come home to roost, or the music stops playing and the entire system unwinds. Because ultimately, if the protocol is going to promise to sustainably pay out some yield, it needs a sustainable source of yield. And in practice, the only sustainable source of yield is real value creation. And I have a tremendous fear, that if Pinto tries to growth hack its way into a major player in the cryptocurrency space, that it is likely to grow significantly. It's almost certainly able to grow to the order of magnitude of a Terra Luna, but then it would probably blow up if the source of the yield were just the protocol saying, here's yield no matter what. I think that's a very dangerous and unsustainable game to play. And it's much healthier if the protocol is able to grow and offer yield, even if it's volatile yield, to participants, because there is demand for holding the currency in the first place. And that's a level of yield, or a type of yield, excuse me, that I think is much more attractive for Pinto to grow off of. And so now we have to talk about the second type of yield, or way to create fixed yield that I mentioned before, which is that through a protocol like Spectra, it is possible for participants in the Pinto ecosystem to basically trade fixed yield for volatile yield, where people can now make a bet effectively that they are willing to pay a fixed yield to Pinto holders in exchange for any excess yield on top of the fixed yield that they're paying. And so this looks something like, I think the Pinto yield is going to be something like 20+%. I'm looking to pay someone a fixed rate of 10% in exchange for any of the excess yield on top of their 10%, something like that. And as a result, through a protocol like Spectra, there is actually the ability to create a yield curve, if you will, where given a certain future point in time, there is the ability for participants in the system to trade each other yield, a fixed yield and a variable yield, effectively creating the same dynamic where for some holders, there actually is a guaranteed fixed yield, but the source of the yield is something fundamentally different. Instead of it being just the protocol promising to pay out yield with no source, in this case, there actually is someone paying out the yield with a source. They are someone that believes that the future yield of Pinto is going to be above some amount such that they are willing to pay the yield. They are paying the yield for the rights to your excess yield on top of that amount, if you will. Or you can make the argument that the better way to understand it is they're paying you a fixed yield for all of your yield from Pinto. And from that perspective, I think that is already a dramatically better and more sustainable source of yield while still offering the property of fixed yield. So that would be, I think you could build it into the protocol at the base layer. I think it's very dangerous to do that. I think in a permissionless environment, and is already the case with Pinto, there is a way to offer fixed yield to the participants in the system that want to do that, but allow the market to both pay the yield, not Pinto, the protocol, and allow the market to set the yield without the protocol having to say this is a guaranteed yield that it's going to pay out. So to me, that's a much safer and healthier way to do it while acknowledging the importance of fixed yield. I appreciate some of the older members of the community speaking here, but also want to encourage, I see we have some newer members of the community. This is an open space. Feel free to come and ask your questions or say whatever you'd like, either in response to what we've been talking about or something different related to the system. Okay, so we have 15 minutes left in the hour. If something comes to people's minds, please feel free to come up and speak. But with an absence of other speakers, I'd like to talk a little bit more about soil issuance, where what we've seen over the past month is experimentation that arguably has failed quite significantly, which is very interesting. Historically, the BIPs that were implemented in Beanstalk and even the PIs that have been implemented to date with Pinto have almost all been quite obvious, in the sense that when Beanstalk was originally deployed, the model was so weak that, and I don't want to undersell it, like it was still tremendously improved over anything that had existed before it, but it was still so weak that there were so many obvious holes that had to be plugged in a timely fashion that each of the BIPs that were made were not changes that really had the potential to damage the economic model. Maybe it's not fair to say they didn't have the potential, but the chances of improving the efficacy of the model versus decreasing its efficacy were it was much easier to make changes that had a much higher chance of being a positive impact. And one of the things that I think speaks to where things are at from a model perspective and just how good things have gotten is the fact that for the first time, we really had a change with PI6, where the amount of soil that was issued changed dramatically. And the change actually seems to have hurt the model, hurt the efficacy of the model. And I feel like it's particularly relevant to have a discussion about hanging out at 61 cents is a good thing and a good sign, because it actually affords us the time to experiment with much more nuanced and difficult trade-off spaces that are harder to know what is optimal to do. And I think the PI6 and the change in soil issuance is maybe the ultimate example of this, where sure, the amount of soil that was issued every season decreased dramatically, effectively in an instant with the implementation of PI6. And sure, this actually seems to have had quite a negative impact on the efficacy of the field and the ability for Pinto as a system to remove excess currency from the supply. Sure, that is true. And sure, that almost certainly has resulted in a greater downward deviation in the Pinto price from its value target. But despite the fact that the field has basically been nerfed entirely, that the field has basically been unable to attract any lenders over the past month or just under a month since PI6 was implemented, despite that fact, the protocol continues to chug. The price has not fallen off a cliff. It's just continued to come down slowly, despite the fact that its primary maintenance mechanism or maintenance tool, the creditworthiness of the protocol, which is the whole backbone of the system, despite the fact that that has been effectively inoculated, the protocol continues to keep chugging. To me, is a tremendous signal of success. And it's a real luxury, frankly, that we now have the opportunity to actually experiment to this extent, where we are able to implement changes that can be undone or improved further based on how they are responded to by the market very easily. So it's not like this is a change that Pinto is stuck with forever by any stretch of the imagination. But just the fact that we can now take aggressive steps like this and perform an experiment on the model that could have short-term very negative effects on the efficacy of the model, but long-term have not really had any effect on the health of the protocol. To me, this is tremendous. It has to be said, this is really exciting. Like, if you juxtapose that with the state of Beanstalk during its first 9 months before the exploit, it was hair on fire constantly. There was always a major problem with the system that if it wasn't fixed immediately, it was likely going to cause the system to experience so much damage that it was not it was not going to survive for very long. And it's quite ironic, not to digress too much, but it's quite ironic to me that despite the fact that we were pushing new code every 2 weeks or so, and this was the most complicated system in the EVM, that the hack had nothing to do with code security or code bugs. It was a design flaw, and not even a design flaw that was part of the development. It was a day zero design flaw. So it's one of those things to now be in a position where we, and I use the collective we here, can afford to make changes to the protocol where it seems like it actually really damaged the efficacy of the model. And that doesn't create any sort of hair on fire circumstances. And the protocol continues to just mosey along and do its thing. And we're able to collect data and then ultimately, hopefully soon, make a further attempt to improve the changes that were made with PI6 to both better incentivize participation in the field and create a more efficient market in the field, while not totally nerfing the efficacy of the field. And I just feel like it's a real luxury. And I know most of the people that are currently in the Pinto community were not necessarily there for a large part of those initial 9 months of Beanstalk, and certainly weren't there for like the first 6 months of it, where it really was hair on fire all the time. People may forget or not know in the first place and have a perspective of, what's going on. The system's at 61 cents. The field's not working. Nothing is happening. It's like, well, just look at how far we've come. Just juxtapose this with the status quo a couple years back when the protocol really was not sustainable and the protocol was operating on such a thin margin of error that any potential mistake like this, like PI6, and I think even in the current context, you could say PI6 was not a mistake. It's just part of the experiment. But back then, it definitely would have been a mistake. It's honestly really exciting how far we've come. So I guess that's rant number 2. We have a few minutes left here. Curious if people have any comments or questions on that, or whether anything else has come to mind since our last little break to allow people to speak.
Hello, can you hear me?
Yes, sir. GM brother, nice to speak with you.
Yeah, hello. I'm very happy to be with you with this sharp minds. Sorry if there is some interruption. My country is not famous with good internet connection, so sorry. Firstly, I want to first thank you for this nice protocol. I'm new here. I didn't invest in Beanstalk or any other things. I want to ask how we can improve the user number. What do you think about this? Because it seems like we are in extreme conditions on the protocol, like the it's like in 60 cents, and like the interest is like 12 times, 13 times. How can we make it normal, and when people come and we have like thousands of users, what do you think about like normalizing, like we have, for example, 15% temperature, maybe, like, or the soil things will be better. What do you think about when more people come, how fast will be the normalizing process?
Thank you for your question.
You're welcome. Thank you.
On the user front, I think doing more public speaking like this and hosting more spaces for the community to come grow organically and for people to just drop in and hear, oh, wow, these guys are talking about something really interesting. I think it's likely to be a good avenue of success. There's obviously a bit of a catch-22 where systems like this tend to grow with a network effect when they're working. But when they're not working, it can be really hard to sort of kickstart the next growth cycle. And so from that perspective, I think just my ethos on this is there's a huge difference in potential outcomes for Pinto depending on the cohort that it attracts next. So if the protocol is able to attract another crew of thoughtful, long-term oriented, potential long-term holders that are able to grasp the thing being created here and choose to participate long-term versus fully extractive, just yield farmers, I think there's a lot of different universes that would exist depending on what that cohort looks like. And so for me, it's like, how do we create the users? I think that's downstream of which users do we want. And my perspective on that is we are much better off trying to conduct ourselves in a way that attracts thoughtful, curious, patient participants as opposed to yield farmers. And I think this is deeply related to the temperature. Some of the feedback that has been shared is that the temperature is so high that at face value, it actually makes it scary for new participants to come, particularly the new participants that fit exactly that description that I mentioned before of being thoughtful and curious and trying to understand the system. It can be very hard at face value to make sense of a 13x return or something like that. So I think the question around what to do about the temperature is a very reasonable one. At the same time, I can't say that I believe that there's much to be done about the temperature. And this is for a couple different reasons. One, in general, I don't think it's appropriate or good economics to mandate what the temperature should be. This could look something like there being a maximum temperature. This is something that ESD, for example, experimented with, where they actually had a maximum interest rate, and the interest rate was set as a function of other values within the system or the health of the system. But in short, the situation that the protocol found itself in was that it was at its maximum interest rate and it was still unable to attract lenders. And in that circumstance, what would happen is that the credit-based system effectively gets turned off entirely. Like the market has evaluated that the system is not willing to pay a high enough interest rate in order to attract lenders, and the protocol is not going to change its interest rate. And so the system basically falls into an equilibrium of no activity happening on the credit side of things. And that ultimately spells like a slow and steady death march, because the main mechanism underlying the peg maintenance ultimately doesn't work. So, in fact, one of the main improvements that Beanstalk made over ESD, which Pinto has followed, is to not hard set the interest rate and to not mandate to the market what a fair interest rate is, but instead introduce a PID controller that fluctuates the interest rate in line with the history of activity within the system in order to find an efficient interest rate, in order to discover an interest rate at which the protocol would be able to attract lenders. Now, at the same time, I think it has to be addressed, the idea that the interest rate is simply too high. How could the protocol possibly afford to pay back loans at a 13x return, if you will? And this is, in some sense, the fundamental question around the sustainability of the Pinto system. The fundamental question is, can Pinto attract enough lenders at a low enough interest rate that it will be able to sustain itself in perpetuity? This is the question. And so in some sense, the the whole system is designed to make it such that the protocol is able to borrow value at the lowest interest rate possible, if you will. And at the same time, you could look at this and say, well, the protocol is looking to pay a 13x. If you buy the Pinto and you also collect the multiplier from the price moving from 60 cents to $1, the protocol is actually paying back something like a 20x. You know, if people aren't interested in a 20x, how could the protocol possibly sustain itself? And to that, I would say, well, the protocol is in its very first cycle. It's in its infancy. And we are now at the point of price discovery, where the temperature continues to increase steadily and slowly, where we are actively discovering as a community at what prices, based on the current length of the pod line, people are interested in lending to the protocol. And I think this all has to be taken in, particularly at small size. You know, I think it's a different thing when the protocol is at tens of billions of dollars. It's much harder to imagine the protocol being able to sustainably pay out a 13x when it's tens of billions of dollars in size, and maybe it needs to borrow, you know, $500 million from the market. It's like, if it's borrowing $500 million of value from the market and has to pay out something like $6.5 billion, that becomes very expensive. However, even that, and whether or not it's sustainable for the protocol to pay out $6.5 billion in interest, or $6 billion of interest plus or basis, is really a question of the state of the system. So it feels much more reasonable for the protocol to pay back $6.5 billion of debt if the supply is $100 billion. And then it's like, oh, the supply just needs to grow 6% in order to pay that back. But then again, it's like, well, what if the protocol is $100 billion in supply, but has $1 trillion of debt? Then it's actually not highly unlikely to be able to pay back all of that $1 trillion of debt if the marginal borrower is also now getting a 13x on hundreds of millions of dollars. So I think at the same time, I want to both say, yeah, paying 13x is not sustainable long term. At the current size, and given that Pinto is in its infancy and really has no credit history, and there's no reason necessarily that people should feel like Pinto is credit worthy. It has no track record of paying back debt. From where I sit, 13x, 1,300% seems pretty reasonable, honestly. Particularly when you run the numbers. It's like right now, the market cap or the supply is like 11 million, and there's like 32.5 million pods, which if you roughly double it, you calculate the amount of Pinto supply that needs to happen for a marginal lender to start to get paid back. So you double 32.5, you get like 65 million. So the Pinto supply would have to grow by 65 million in order to pay out a marginal lender. And it's like the current supply is 11 million. So you're basically making a bet that the supply will go from 11 million to something like 75 million, 77 million. So the supply is going to 7x. And in exchange for making a bet that the supply is going to 7x, you get paid a 13x by the protocol, or from the protocol's perspective, and a 20x overall. Like that seems like a reasonable bet for someone to take. Like that seems like a reasonable trade for someone to make. And from my perspective, it also seems somewhat sustainable by the protocol. Now, I guess, and this is really where I think the rubber meets the road on your question, the real question is, let's say that the protocol starts to grow and is able to actually exit this debt cycle, enter a growth cycle, start to pay back this debt. And let's say the protocol grows 10x or 20x, and now it's at about 100 million or 150 million supply. It's paid off all the debt from this cycle, or a tremendous amount of the debt from this cycle. The L2SR is up, the pod rate is down, the system is healthy. Now the question is, okay, well, what does it look like for the protocol to now lower the temperature? And I think two things are true. One is the fact that the temperature is so high almost certainly does have a negative effect on people's willingness to lend to the system at a lower temp. Like the game theory, if the temp is at 1,300%, is such that people are probably going to prefer an interest rate much closer to 1,300%. And so there is some cost in terms of people's willingness to lend at lower interest rates to the system of having such a high temperature, which is an argument for lowering the temperature quickly. On the other hand, the morning auction is a highly efficient way to have, assuming that you have competition in the field, assuming that you have multiple lenders. It's a pretty efficient way for people to bid. It's not the most efficient way for people to bid, but it's a pretty efficient way for people to bid on the soil, such that even if the maximum temperature were 1,300%, if there was enough demand for soil at 100%, you would expect maybe not only if there was enough demand for soil at 100%, but you would need like sort of eBay rules, like the next lowest lender to also be willing to lend at 100%. So there's some competition. You could imagine a situation where the protocol, based on the way the morning auction works, that even if the maximum temperature is 1,300%, the protocol is actually only paying 100%. So I think this goes back to two things are true at once. Like one, I don't necessarily expect the protocol to pay out 1,300% in perpetuity, even if the temperature doesn't come down. But the temperature coming down would likely benefit the system insofar as it would allow the protocol to likely attract lenders at a lower interest rate. However, there's now a cost, which is if the maximum temperature is 1,300%, the protocol is basically saying it views it as worthwhile to pay such a high interest rate in order to return to its value target sooner. And this sort of puts Pinto back in the basis state space around, okay, like up to some maximum temp, the protocol is willing to pay any interest rate up to that maximum in order to minimize volatility as much as possible. And so if anything, I feel like the place to take this is to figure out, is there a way to price the temperature in a way that is a risk management tool for Pinto? Like Pinto believes that it could pay up to this amount in a sustainable fashion. And that's a whole different design space that has really not been explored yet. But this is the reason why we currently are where we are. It's like there's already a mechanism, the morning auction, in place such that the protocol really shouldn't overpay too much. And we really haven't had a chance to see the morning auction work in practice. We've never had that state of the system where there's an excess of demand and the temp is too high such that the morning auction can do its thing. So my instinct is that we shouldn't really be changing the temperature until we get some of that data. I could talk about this a lot more, honestly, but I was just informed that I am late for another meeting. So I am going to wrap this up now. We did a little over an hour. I think this was great for our first X Spaces. Particular thank you to our new community member who participated in the discussion for the first time. Really appreciate you. And looking forward to continuing this discussion either in the Discord or on a future call. So I assume I didn't answer your question fully or to your satisfaction because there's a lot more to say here, but hopefully this was a start. So thank you everyone for coming, and we'll hopefully meet again soon.